we're now going to hear from Dean Wehrli with John Burns Consulting, PhD, podcast extraordinaire, and all around great guy. John Burns Consulting, I have nothing but respect for them. I value and evaluate the quality of their material as some of the highest in the industry, bar none. So, Dean, it is always a pleasure to have you with us sharing some of that.
Thank you, Joel. I appreciate that. I'm going to share my screen now and pop up my slides. Okay. And then now I'm going to start slideshow. Beginning. Give me well, God, I'm not going to be as good as Ryan is at looking at the chat, but can somebody give me a chat thumbs up that you can see my slides okay? Or verbal?
It looks good, Dean.
Okay. See, I see the chat. I see a bunch of chats coming up and I don't see them. So that's probably my fault for the not knowing how to do that. So I'm not gonna be able to weave in. Ryan does an actual weave, not a fake weave with that. He's really good at that. So I'm gonna talk first about here, that's what we do. Joel just went over that. So here's my outline. I actually literally just added some economic because what Ryan just said. It's gonna be. I mean, I'm talking 90 seconds ago. So, but I just did it for the VIA in the Bay Area. It is going to be some national economic overview. I'll go through it very quickly, and also some national housing data. I'll go through that first section there very, very quickly, and then we'll look at Sacramento and regional, meaning Northern California trends in housing, in pricing, and sales. And then I'm going to, in part three there, you see, I'm just going to be, if Ryan gave you a slap across the face with how unaffordable we are, I'm going to give you a punch in the throat with how unaffordable our markets are. And then we'll look at, and I'll probably spend a little bit of time on that. We'll look at part four there. It says builder strategies. That's essentially what, and I hope that's interesting to this audience, is essentially what builders are doing to combat and to kind of solve for price right now. And then we'll end it with some projections for the next through 28. Okay. So here's national economic. Um, Again, I'll be very brief here, and I will share these slides, by the way, too. So don't take pictures of what I'll send Joel a PDF of this after we're done. So here is our projection for job growth. We see in 2026, we see very modest job growth, but still positive job growth, which is encouraging. The NAR, right? I mean, the NAR is overly optimistic in a lot of ways. That's one of the ways here. That's what we're not going to have 1.3% job growth. Job growth is clearly slowing. There's even the potential for it to go negative. We'll see, but it's slow, but still positive. And that's not so it's kind of a status quo kind of environment. Here is on the national level what we are projecting by MSA. So MSA is where I'm not going to get as granular as Ryan is. And most of our data are going to be at the MSA level, and often that's just a simple county. Usually that's a multiple counties aggregated. In the Sacramento case, for instance, it's Sacramento County, Placer County, Yolo County, and El Dorado County all combined into one. That's the Sacramento MSA. But you see that we do expect some continued kind of Sunbelt job growth. You see the Bay Area is having MSAs having kind of the weakest level. In fact, they have some job losses over the last year. This is looking backward, by the way. And again, I apologize. I literally just added this. So this is probably a couple months dated. That these figures actually in job change in California are actually starting to shore up a little bit. I'll skip that, but you can look at it. You see high income job growth, however, does concentrate in places in places like San Francisco and San Jose. So that's the tail here. We talk a lot about prices in those core Bay Area markets where things are insanely unaffordable are still holding up pretty firmly. In fact, in San Jose, they're positive, because they just play to a very, very small part of the market. And because their supply is so heavily constrained, they don't need to service much more in the for sale world than a small part of the most affluent part of that market. Household income growth is still holding up pretty well. And again, places like San Jose, East Bay is okay, but places like San Jose have the strongest, and Los Angeles have some very, very strong income growth. Look at Sacramento here at 3.7, by the way. Again, I did this for a Bay Area thing, so you see these arrows are Bay Area oriented. And then I'll skip over this, but again, it shows this is GDP growth, gross domestic product, So it's just overall a metric of economic growth by state. And again, you see actually California holding up pretty darn well, ahead of the national norm, or roughly at or slightly above the national norm. So AI, I mean, AI has propped up Northern California, especially the Bay Area economics more than people think. In fact, I've seen estimates where the national GDP has been improved by about 1 full% just by business AI spending, which is, I think it might be counted in the trillions of dollars now. Certainly the many, many hundreds of billions of dollars of AI spending. It's just a massive infusion into our economy, because mostly we are 2/3 to 70% a consumer spending based economy. This has really goosed business spending part of that dramatically with AI spending. And you see these bubbles are essentially, this is the Brookings Institute's analysis, by the way. Those dark blue bubbles you see here are basically San Jose and San Francisco MSAs, where a lot of that spending has been concentrated. Sacramento is a little considered an emerging center of this kind of spending. It's not dramatic, but still on the plus side, it's been an improvement. But so we'll continue to see how that works out. You're starting to see some AI doubts creep up out there. So we'll see how much longer, as long as those guys continue to spend an insane amount of your money that they get by overpricing smartphones and things like that, then it'll goose these economies in Northern California, but especially the Bay Area. Now, national housing, this is again, this is national here. This is what we see in terms of, I'll go through this very quickly. We see the total home sales for next year being about $635,000 national. That's single family home sales, and then creeping up after that in 27 and 28. So still, you can see from a perspective of the crazy days of free money, that it's way below. But from a long term norm, that's a little bit stunted, but not a dramatically low level of national sales. New homes have kind of recovered the share of the market to about 14%, which is kind of a rough long-term norm. This was gutted with all the REOs back in the bad old days. It's recovered most dramatically with the increase in mortgage rates. And the reason, of course, is because you've had listings constrained in the resale world, combined with new home builders being able to incentivize much more than resale folks have done, and sort of recapturing that level of the market that they historically have had. We'll see if they're able to retain it as over the next few years listings kind of return to normal. But right now it's at a kind of a long-term norm. And then pricing overall, I'll get into this a little bit later. This we call the BHVI, Burns Home Value Index measure. It's a measure of market movement, something like the Case-Shiller measure. And basically home prices are fairly flat nationally. And then in terms of months of supply, I have a better slide for that in just a minute. I'll show you national and Sacramento month supply in just a bit, okay? Here, like two things more on this national slide is mortgage rates. This is our projection for mortgage rates going forward. My personal take is this is probably a little bit high. Our method is to take the read from the bond market, because that's the best predictor of where mortgage rates are going to go. And so we don't see mortgage rates slipping dramatically. They have, however, been better. As we know, they've been creeping down. This is Fannie Mae. They do this weekly. This is their overall 30-year national mortgage rate. It's been creeping down since very early this year, where it peaked at over 7%. You can see here on the left. I hope you can see my cursor, but you can see it over here on the far left of this graph. This is the 30-year rate, the blue line. This is it's been popping down since, roughly early June or late May, and it's been coming down pretty nicely. Right now, as of today, I checked the Mortgage Daily News. It's at 6.07 as of today, which actually popped up a little bit today, unfortunately, but it's still, my guess is when Thursday Fannie Mae, the new one comes out, it'll be, 613, 612, something like that. So this is good. This is really both for buyers, but also for in the new home world, it allows them, or even resellers, if they're going to play in the world of buying down the buyer's rate as a concession, then it makes those concessions and those incentives a little bit cheaper for folks. Now we go to the sales and pricing in the Sacramento region. I know this is a brutally it's a very hard to follow, because we have a lot of lines, a lot of moving parts in this slide. But what we're showing on the right here is you'll see the detail for the Sacramento MSA, and on the chart itself here, you see the all the MSAs, the major MSAs in Northern California. And again, this is like Sacramento is a 4-county MSA, San Jose is Santa Clara and San Bernardino County, etc. San Francisco, by the way, is San Francisco and San Mateo counties. The East Bay is Contra Costa and Alameda, etc. Stockton is just San Joaquin, and Vallejo is just Solano. But what the main thing I see here is that in the new home world, Sacramento is the vast leader. If you want to play in the new home world in Northern California, you're going to have to come to Sacramento to do it. So you're going to continue to see a lot of new home builder activity here in greater Sacramento, because that's kind of where they have to go for the divisions up in Northern California. You see a lot of actually those Bay Area divisions are starting to be given or have already Central Valley areas to make up for the lack of volume in the Bay relative to Sacramento divisions have. And look at the next one here, this yellow here, that's Stockton. So these two inland areas are where the vast majority of the volume is in the new home world. Again, for obvious reasons, the constraints in the Bay are just much more dramatic in terms of available developable land and the cost to build that land, and of course the cost to sell those homes. Existing home sales, I know this is just we know what's happened. It just fell off a cliff with mortgage rates. This is the whole golden handcuffs. It does appear to have stabilized in all of these markets over the last couple of years, stabilized at a historically. I mean, this is the main reason I show this. Stabilizing at volumes in Sacramento is about 20, I think here is about 23.6. And that's for the fine. This is from public record. So this is more inclusive of MLS. It's about 23.6, I believe. I have that right. Something like that. Just look, I mean, look at this. Even this is worse than the worst days in some places of the complete, GFC, where the market just tanked. So it's a very low level. I wish we can go back to the 90s and the 80s here, but it's still going to be well above this level. In the 80s, it was probably double this level. So we've stabilized, but stabilized at volumes at an extraordinarily low historical level. Price. Now, again, we see kind of the opposite here. The places where it's constrained and where you have this great job growth, or you have less job growth obviously in San Jose and San Francisco, but you have high incomes and you've had historically phenomenal job growth and very good jobs and a high level of affluence. You see these insane prices. And then you also see down here in Sacramento is, we of course, we know this. We have this level of affordability that is, it allows for that augmentation from Bay Area buyers into our market that is not going away completely. It's nothing like it'll be after COVID. We had just sort of this reset. That's gone. Those days are over, but you still have the residual augmentation of demand from the Bay Area. That's 8, 10, 15%, depending on the submarket, of those folks who have a job in the Bay, but they're able to live in Sacramento area for whatever reason or another. Again, not the back to office thing will probably pull a few more folks away, but it seems to have stabilized at a higher level than pre-COVID, but not nearly what it was during COVID. It's kind of a missed opportunity, I think, for a lot of reasons. Home price, I'll just let you. Again, you can get this but this is existing home price by MSA as well. I'll skip right over that. This is that BHVI I mentioned. So what this is sort of Case-Shiller-like. It looks at same property versus same property over time. And so it's a really good measure of market movement. It's an index. This is the Sacramento MSA long-term historical norm down here since 2000, and kind of the most recent monthly changes here. Not unexpected, we've gone negative. As Ryan said, we've gone modestly negative. Right now, we're at about negative 1.3% year over year by that measure. Latest data available as of November. Our long-term norm is about 4.7% annually, which is higher than the national long-term norm. But look over here on the chart I added here. That's January 20 through December 25. So basically over 6 years. This is what this BHI is being measured by Northern California MSAs. Here's Sacramento at 35%. That's a little bit under 6% annualized basis. A pretty solid rate. Not unsustainable, probably a little too rich to go on forever, but not insane. And that's, for the most part, that's true. I'm going to show you in just a few minutes, though, how that changes when we add the element of mortgage rates. So overall, we are losing price. It's been pretty modest, but I'm going to be brutal with affordability and show that there is room there is an argument to have continued price correction. And we do see a slight price correction But our thesis right now is that most of the depreciation is behind us. I want to show months supply because that's a critical measure. And one of the things that people, I don't know if everyone realizes is that California MSAs for the most part, and over here we have the Sacramento MSA on the right here, we're at about 2.25 months of supply. I know there's all these, the old school was 6 months supply was kind of equilibrium. That's done. You hear a lot of folks think 4 and 5 months. There's just less friction in transactions and people are savvier and there's so many uh, sources of mortgages that maybe it's 4 or 5 months supply. I don't know what the right number is. I think it's probably a little less than 4 or 5 months supply is an equilibrium market. Right now we're at 2.25. I think by any measure, that's a constrained market in terms of months of supply. Look at the national. The national though, the national is more like 4.5 months of supply and it's going up. And that's from places like Florida and Texas, the Carolinas, Tennessee, Nashville is very, very heavily supplied right now. I know some folks here know that. So we actually are in a more stable housing market environment right now than a lot of those high flying Sunbelt markets. In fact, we're kind of the best performance has been in like the Midwest, the Northeast. Your Appalachians have been doing well. Detroit has some very good year over year numbers. Crazy enough, Philadelphia, New York has the highest rent rate in the nation right now, year over year in terms of rental rates for apartments. So, and San Francisco is solidly positive on that measure as well. So you are having in California, our relative constrained supply does kind of bolster the market a little bit, and it's so your pain is being really felt in Florida and Texas are the poster children right now for housing market pain right now. Places like Austin is just crazy oversupply. So I want to show this to show, like Ryan said, that right now in December, we have a lowest level of listings, and this reflects that. So listings have come way down. So what I did is I did months of supply right here, and this is median days on market, and this is the percent difference between the asking price and the sales price by submarket. So we have Natoma, South Placer County, et cetera. South Placer, by the way, is Roseville, Rockland, and Lincoln. What else? Oh, this is Folsom, El Dorado Hills. Otherwise, these are cities. Natomas is just those 3 zip codes that comprise Natomas. So what you see here consistently, and I know this 1.35 a month supply for 3 different submarkets. I was really suspicious about that, but I disaggregated these data for these, and they are different. It's just a weird coincidence right now that 3 of these submarkets have a 1.35 month supply. That worried me for a bit. So what you're seeing though is a very constrained market here. You will see these numbers, you'll see the listing numbers perk up here immediately, starting this month and so on. But you should also see the sales numbers perk up as well. I do expect these month supply to go up, but not dramatically. When I did this about 3 months ago, by the way, these are like 2.2, 2.3, 2.4, 2.5 kind of range. So they are down because listings have come down so dramatically. But we still, when things are kind of normalized here, you still see a pretty constrained level of supply all throughout the submarkets of Greater Sacramento. So that's again that and these days on markets 2022, 23, those are great. 30 plus is considered kind of roughly normal. The only place you see that is Rancho Cordova, which is a little bit more richly supplied right now. But otherwise, you see a lot of constrained supply, and you see that prices are pretty similar. The bid ask should be that usually is slightly negative on average. So seeing negative 1.1 and 0.9 is pretty normal. So this is actually, this again kind of speaks to this a little bit more stability in the market than we might think. But now here's where I show you how we could see a lot more pain. And certainly there is an argument again to be made for, prices. You can see prices coming down more dramatically than even we are projecting, by the way. So this here, again, is that BHBI measure I just explained. Again, this is an index measure. It's a really good measure. I'm sorry. I apologize. This is our affordability measure. It's not completely the same as the NAR one, but it's similar. It takes the inputs, things like income from that MSA, the specific MSA. So this here you see in the charts here is the Sacramento MSA. We think the normal level should be about 35%. Now we're at 40%. The higher you go, the less affordable a market is. So higher bad if you're a buyer. Really bad for everybody, but higher means less affordable, lower means more affordable. This 40% level is roughly similar to the national average. So the whole country is relatively unaffordable right now. Um, but look at these Bay Area ones over here. San Francisco has an 87% BAI, Burns Affordability Index right now. San Jose, 79%. Even the East Bay, 56%. That's insane. So this is why we get that augmented demand from these Bay Area places, because they are even more price. Those buyers there are facing even bigger price hurdles than we are in Sacramento, and they are moving if they are able to. They move to Sacramento for a bigger house for less money. With the return to office, though, that's again it's still here, but it's much slower than it was, and it's something that we definitely keep an eye on this figure. I'm going to show you it's worse though when we compare it to places out of the state. So we'll see that in a minute. What I do for the next couple of slides though, I apologize, I wasn't able to update these data. They're a couple of months old, so it's a little bit dated, but not that much. They go through September. So this is essentially showing on the left side we have resale home prices and monthly payment. The pricing is in the blue line here, and it's month by month. The orange bars are monthly payment. Over here on the right, we have new home, same data, but for new home. And this is and our y-axis is price. Sorry, my mouse is very sensitive. It keeps on flipping. So you have what I want to show here is just this gap here between prices are shooting up. We know during they're going up nicely in 19. They're kind of flat, but then this is the COVID era here where prices just starting just exponentially rising. This great days for Sacramento. Sacramento was one of the national poster children for this outward movement from COVID because we had all these folks not being able to buy homes in our relatively nearby Bay Area, and they were able to flood Sacramento and also the Stockton MSA, and also, of course, they went to places like Phoenix and Austin and Reno and places like that. But they mostly moved one county or two counties over, and so Sacramento was able to absorb a tremendous amount of that. I'm able now to live where I can afford the biggest home or biggest, nicest home. So I'm going to go to the Sacramento area with my job based in San Jose because I'm 4 or 5 at first. I'm completely work from home, and even later on, it might have been 4 days or 3 days. Again, that's starting to pull back. They're pulling them back into the office. But what happened is that, of course, we flipped the switch with mortgage rates, and you started to see the orange bars just shot up immediately. And you can see some discrepancies here. The reason between prices and monthly payments because the mortgage rates were shooting up even more. So we have corrected in price. We see here's the correction in price. We've more or less kind of been shooting, but the gap between monthly payment and price has just disappeared. The same for the new home world. So the much more pain has been felt because of mortgage rates in the monthly payment. And that's the bottom line for folks buying homes. Here's the same data, but what it is cumulatively the percent change cumulatively starting in January 2019. Again, blue is price, orange is monthly payment. They're kind of trending together. Price is ahead of payment. Mortgages are cheap. Money's easy. Flip the switch in early 2022, and the monthly payments just shoot up immediately. Prices react fairly quickly. But mortgage, and since then, it's continued to we see the same kind of trend, this kind of jagged sawtooth kind of trend, roughly stable, actually slightly up if you count since, say, early 2023. But the mortgage rates have now monthly payments have now outpaced and outgrow the pricing pretty dramatically. You see a little bit less, by the way, it's hard to see, but new home folks have actually done a much better job because they're able to incentivize, and the best tactic they've found is a buy down, and they're able to get those buy downs fairly cheaply because the big ones, the Lennars and D.R. Hortons of the world, are able to go to Wall Street and get a ton of money. They get tranches of 4.875s, hundreds of millions of dollars of it, and they're able to dole those out as an incentive. And it's expensive, but it's not as expensive as a consumer buying the same kind of a rate buy down because they get that money cheaper in mass. So they are able to use that as incentive and make it much more affordable than the resale world can. So they've been able, but what that means is that the actual net of incentive pricing for new has been much more negative than it has in the resale world. And we'll see that in just a minute. Here is the one I think is the most eye-opening in my mind. So again, I'm doing this on the Sub-market level, I've included Sutter Yuba here, which is 2 counties, and Yellow County here. Otherwise, these are those sub-markets we just looked at a minute ago. And what you see here is since 2019 through, it was, again, I believe it was through August of 2025. It's a little bit dated, but I'm pretty sure it was August or September 25. The data are through. So not, 6.6 or 6.7 years overall. And you see right here, you see by submarket, see the 43.7 there for Folsom El Dorado Hills. That's the total cumulative price change over that period. Strongly positive. But again, 39.6, 41.3, like 6-ish, not sustainable forever. You can't have 6% depreciation forever. Even some of these are a little bit higher than that. But you can have it and not break the bank and break the market. People can adapt to that. You're going to squeeze buyers. You're going to get a few buyers. You're going to squeeze a little further over to that right side of the income distribution chart. But it's not crazy numbers. These are crazy numbers. This is the monthly payment over the same period. So that 43.7 price change in Folsom El Dorado Hills is an 82% monthly payment change in those 6.5 plus years. When you translate that to monthly payments because of this increase in mortgage rates. And that's despite a continued increase in income, by the way. So that's a double digit now. That is unsustainable. That is going to break a lot of folks. That has winnowed out the potential buyer pool dramatically. There are folks who just cannot be home buyers anymore with a monthly payment price scenario like that. It's because of mortgage rates. Mortgage rates, though, are like I think I told you right now, it's what 6.07, something like that. That's lower than the long-term norm. The long-term norm, as going back to 73 when Fannie Mae started doing that, it's about 7.6 or 7.7%, something like that. Again, that's including those crazy 80s and things like that. But even if you say it's 6%, which is, I think a lot of people think of that as a normal mortgage rate. We're at a normal mortgage rate right now. But what it's done, because of those years of a not normal mortgage rate, it's led to these crushing monthly payment price increases that are just, that's why we see a lot of pain in the market that we do. And now what I do here is I'll go through this pretty quickly. I sort of just pretend we had a 4% rate over this entire period from January 20 through today. I know I said we're 4.7% on our BHI, but 4%, rough average, typical, normal, long-term normal level of appreciation, above inflation, usually. Where would we be? And here's where we'd be. And here's the blue is where we actually are. So we're just, had we had this normal rate, we'd be here. We're actually here in terms of existing price. And in terms of new home price, we're actually a little closer because, again, those new home folks have been able to incentivize and been closer to the market. New home people are more reactive and more immediately reactive to the market than resales are by a lot. So if you really want to see where the market is, you really look at the new home market more so almost than the new existing market. To some extent, I want to exaggerate that, but to some extent, that's a smart move. Closer, but still well above where that kind of should be scenario would place us. I'll go through this last one quickly. You still see... This is entry level, so it's a little bit weird, but these numbers here, but essentially housing costs are still dramatically even above single family rental. So these builders are finding that they have more competition in single family rental because folks are priced out of the for sale world. And of course, apartments is a different product, but single family rental is a reasonable alternative. So we're seeing more build to rent, and we'll see more of that in the future. And income growth has lagged price growth. It's been solid, but this is Sacramento, but it's lagged price growth and badly lagged mortgage payment growth here in the orange. And in terms of nationally, this is a picture of where San Jose and Sacramento move out to. And you can see what I said at Sacramento, they mostly move East Bay, Yuba, Vallejo, LA, San Jose, Stockton, San Francisco. Most Sacramentans move out to Northern California. Here's San Jose. East Bay. Everybody thinks, oh, it's Austin and Oklahoma City and places like it's not. Most of the out migration was within the state. Then is 1 or 2 counties. Don't get me wrong. California lost population, not anymore, and had a lot of folks moving out there. But it's a huge bucket, and it's a drop in our bucket. But it's in places like Oklahoma City and Reno, it was a big impact because there's. But what the point here is, my point is that even though Sacramento is cheap relative to the Bay. It's not cheap relative to a lot of other places they can go. The problem is now they're less likely to take their job with them than they were during COVID for these places. So you have seen a pullback in that out migration. Mine, I just saw something in California is now actually slightly positive, so that it's that out migration or that net out migration has ceased, and is now kind of stabilized at present. Real quick, people don't feel it's a good time. Only 27% of folks feel like it's a good time to buy, and people are staying in their house longer than they used to. And I'll go through this very quickly, but this is Ryan mentioned about that you do have this kind of a have versus have nots kind of a world. So what I did here is I divided all of these metrics: months of supply, median days on market, median ask minus sold price, and the year over year price change. We should see all these metrics be better at the lowest deciles. That is, these are tenths of the market, and by price, by the way, by price for 2025 sales. Hopefully that makes sense. What we see here though, is just chaos. So you should see the least month supply here in the more affordable parts of the market. And you kind of do a month supply, but you don't look at median days on market. You actually see more median days on market. So you see, which is, by the way of saying, a little bit weaker conditions in the entry level part of the market. Again, when there's typically these would all be, you see the entry level part of the market is there's more demand there just from sheer price. And so you should see these numbers over the last year or so. They've kind of flipped in, but they haven't fully flipped in Sacramento. So this is, by the way, I'm sorry, I should have said locationally, I chose South Placer to do with this. So it's Rosen, Rock, and Lincoln. I try to use that as kind of just sort of emblematic of the larger overall Sacramento MSA. And then, but you see, there's just not a pattern here to look at. Now I did the same exercise for the Silicon Valley, a very affluent area. It's insane. This was beyond my wildest dreams. I wanted to show that, yes, the strongest part of the markets are the most expensive parts of the market. I did the data. It's crazy. Again, that pattern you see here, all of these should be reversed in a normal market, a market that's acting rationally. But you see the biggest strength actually is in places, especially affluent places. This is also true in the Tri-Valley. This is true in San Francisco. That you see that it's the highest priced parts of the market, and the reason is because those folks have just FU money. And they're not really worried. They're often paying cash and not even worried about what the mortgage rate is right now. But where people sort of need their job and are a little bit concerned about their job, they're very hesitant right now. And in the Bay Area, that could be $1.5 million townhome. But those people still need that affluent tech job. And if they lose it, they're going to not be able to afford that $1.5 million townhome. I know those prices are insane, but it's true. And so they're concerned right now, and they pulled back. Again, in San Francisco, you don't see that, but you also don't see what you'd expect, which is the strongest part of the markets in the lower levels. And I know part of that is because affordability is because they're harder to qualify and things like that. But you still should see more demand in that lower part and more health by these measures, especially things like median days on market. Historically, you always have much higher median days on market the higher price you go, and that's just simply not true right now. So there is, even here in this submarket anyway, there's a little bit of pushed some of the strength into the higher price parts of the market relative to the norm. I'll go through this. I don't know. I'm not going to lie. Oh, I'm almost over time here. Joel, should I just wrap it up?
Oh, you're fine.
Are you sure? Okay, I'll go through
Yeah,
this
yeah,
very, very fast.
we're
What
good.
this section is this is what new home builders are kind of doing. This is what new home builders think of this as strategies that you're going to see from the new home world going forward. One of the things you're starting to see more of is ARMs, adjustable rate mortgages, a little bit higher. It's a little more prevalent in the new home world than it is in the overall world, but it's nothing like it was in the 04, 05, 06. It got as high as 35%. It's nowhere near that, or 34%, I guess, here. And then again, yeah, I got about 35% in 04, 05. We're not going to see that, but we are seeing like 7-1. So the idea is that, can you refi in the next 7 years? I think more and more people are saying yes. I think what's happening though is that if they're younger buyers and they're asking like their parents to say, do not do it, we lost our home with an ARM. So even though I think right now it's actually a pretty good bet, but you're just seeing it sort of creep up because you do have to qualify now because of Dodd-Frank, thankfully, you have to qualify at that highest rate. So it's not the easy money it was back here. So I think we'll see more arms. Um, Here is sort of the idea that as people get, like Ryan said, it's very true. Most of those movers are life stage movers. They're moving because they have to, moving from a divorce or a relocation, or they've just outgrown their home, or they've had kids, or empty nesters, or what have you, or retired. Those people would be pulling out from those 2.8 or 3.2 mortgage rates, and they'll reset to a higher mortgage rate. We are seeing that. So we're seeing that nationwide average mortgage rate start to creep up, right? You can just kind of see it here in this dark blue line. You see that? That's going to take a lot of time. It's going to be kind of a glacial pace as those people get peeled off of those handcuffs. Those golden handcuffs go away. It's going to take a long time, but it is starting to happen already. And it's just going to be kind of a cumulative effect. This is kind of misleading. And the reason I say this is because, right now, nationally, this is a national number again, we don't see a new home price advantage of resale. That's, of course, not true in real. If you're comparing apples to apples, there's still a decided advantage in new home resale in terms of price, as there should be. But what it's really measuring is two things. One, a lot of the new home stuff is going out to more distant, more affordable locations. And as we'll see in a second, the new home folks are going smaller in terms of homes and denser in terms of product type, in terms of lot sizes, or attached versus detached, things like that. So what it means, though, is that the new home options are, you might have to move out, you might have to have a smaller home, you might have to have a denser home, but they're more competitive with the resale world than they historically have been. And they'll continue to kind of solve for price in these ways. Again, this is section sort of how are they going to sort of solve for price. Another thing they're going to do, new home builders, is go smaller. So we see that nationally here in terms of the sort of the average size of the homes. I know this is difficult. This is actually a building product slide here on the left, but this is the average square feet of a new home single family house built for sale. And you see everybody's going smaller here recently. And then this is the number of percentage of homes being built that were under 1,800 square feet. And you see it coming down, you see it going really shrunk here because prices were so comparatively cheap. A lot of the REOs are still getting worked out here a little bit. Prices start to go up and the number of smaller homes goes up. It's a price thing, not a preference thing. And that's just shot up these last couple of years because builders are having to solve for price. And one of the ways they're doing it is building smaller homes and getting higher densities. What builders I think also will do will be figuring out spec levels. And so you already see it. You see them pulling back on the level of spec, the finishes and features that they have in theirs as standard. They'll let you spend as much money as you want. Although, well, you know what? I take that back. That's less and less true. Because more and more new home builders are going for packages where you get A, B, C, or D, or whatever, and you pick one, and you have A maybe the standard, but B, C, and D are some level of upgrades. You need to pick one package, and that's what it's going to be. And very often, because of their build schedules, they've had to pick for you already. So you see less choice in the market, but one of the ways, but you see less choice, but you also see kind of a pullback on that level of spec and to more basic specs, which I think is fine. People can upgrade at discretionary. I think is not a bad way to go. And what this shows is that buyers are okay with that. This right here is 65% buyers said yes, we would compromise on home finishes and style and things like that. Only 35% no, I want what I need. And at the entry level, where we have the most, the price concerns, that number would be much higher. So I think you will see things like amenities and spec level and again go down, if that's the right word, and then things like lot size and home size lot size and home size will also come down and be more dense and smaller homes. The same thing. I'll let you have that. And then, of course, the main thing they're doing is incentivizing. This is a little while ago, but home builders are seeing their margins be depressed because of incentivizing. But guess what? They're not from the long-term historical norm. They're not that far off of it. They're just much lower than they were in the tremendous days of 21, 22, and late 20. So they're still they're still surviving. They're still doing well. They're still profitable. They're just seeing their profit margins squeeze because of all the incentivizing they're doing. But I'm really just including this as a mnemonic for me to say what the main thing new home builders are going to do is continue to incentivize. There's no new home builder that doesn't have some kind of incentive out there The primary tactic is a buy down, but it's not the only one. It's maybe not as universal as you think. A lot of times it's closing costs or something like that. But they're absolutely incentivizing at times extremely aggressively, depending on the submarket and the level of competition. This is well, so our argument is that you'll see projections here in just a minute. I'll go through this really quickly, Joel. And if you want me to, just bring the big hook and pull me off if you need to. So just until 27, this is just me trying to be cute. I try to think of things. One thing I found out is that there aren't a lot of words that rhyme with seven. So is it lemon? Is it, do we, I have a confession. It won't be much better till 27, but it might have to be a felon to 27 because we're going to continue in 26 to see, I just love Spinal Tap. And I didn't know there was a remake of Spinal Tap recently. No one told me. And we think 27 is a return to positive growth. We also think 26 is actually a fairly modest downturn. You could think that's crazy given what I've just told you about how unaffordable we are. But we haven't seen, like Ryan said again, we haven't seen that just price depreciation. I think Mark Zandi is wrong. I think Mark Zandi is a really smart guy, but he tends to be a little bit of a glass half empty kind of a guy. Um, but I want to say this. I know this is consultant level weasel words. There is absolutely an argument for there to be a more aggressive downturn in terms of price than we're projecting and than most folks are projecting. But the market seems fairly stable. New home builders, particularly, are able to get people into homes for cheaper than you might think. Those buy downs are very, very effective. They really lower the monthly payments. They're still, 4.875 or something like that is still higher than their 3.2. But remember, they're selling to a lot of folks who are entry level buyers who don't have a mortgage rate that they're tied to. So the tactics have been. The adaptability has been pretty impressive, and they've been able to hold on to sales and pricing, maybe more so than you think. And when they really need to give on price to get those sales back up, the big builders have shown a willingness to do that for sure. Like Lennar, DR, KB Home. They will lower the prices or boost their incentives to sell homes. This is what's called the EP index. So the EP ratio is jobs versus permits. The idea is that 1.1, 1.2 is kind of normal. You need a little bit more than one job to generate one unit of housing demand. We do project that Sacramento will be slightly below that 1.1, 1.2 level, but you see years of just insane pent-up demand. And remember, Sacramento also gets an augmentation from those Bay Area MSAs, which have even better EP ratios that have been pushing buyers to Sacramento. So this is not bad. It argues for probably a fairly stable environment. Again, we do think, I'll show you in just a second, we do think that prices are going to go down this year. Here is volumes. What I said, we are projecting something like 6,500, 6,600 new home sales in Sacramento, the big man on campus with respect to Northern California for sure. Price movement, this is that BHVI measure. And again, so this is best to think of as a resale market. The vast majority of these transactions are resales, or at least more than 86%. So we are seeing that go negative this year and go modestly negative again next year, we project, before returning to modestly positive in 27, 28. New homes, we expect something fairly similar. So here you see you had a lot more give in the new home world than the resale world, right? In 25, these folks were wheeling and dealing to sell homes. We expect a little more pain next year if you're a builder, a little better if you're a buyer, and then we expect a return to kind of modest appreciation next year. Again, this is the Sacramento MSA. Okay, I'll do this for a recap. I'll just fly through this. I think I'm done, Joe. I've taken up more time. Here is my. I will again. We'll give you these. Good Lord. This is crazy. Here is my QR code. I don't know. Can you do that on this? Here's my contact info if you need it. But give me a call.